Hello and welcome to Connected with Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Rob Moulton, a financial regulatory lawyer and partner in Latham & Watkins' London office. In this episode, we're going to discuss the key cross-sector trends for financial services firms to look out for in the year ahead. To discuss these topics, I'm joined by my colleagues from the London office, Nicola Higgs and Becky Critchley. Nicola is a partner and Becky is a counsel in the practice here in London. Nicola, Becky, welcome to the podcast.
Hi, Rob. Thanks for having us.
Thanks, Rob. Looking forward to discussing today.
Me too. And Becky, let's open with one of the fastest developing area for firms, AI. What do financial services firms need to be thinking about when using AI?
It's a really great question, and it's an interesting one from a UK perspective because we don't actually have a specific AI regulatory framework yet. And although this might change in the future, there's no suggestion that is coming down the horizon. But we know from both the FCA and the PRA that they've quite firmly set out their stalls in relation to the existing rules that are relevant to firms' use of AI here. And particularly here, we're thinking about governance and oversight of the use and deployment of AI as being key to firms managing the risks that AI might pose to their businesses. We know, for example, that the FCA has said there needs to be a robust governance structure in place for the approval and sign-off of AI, and for the ongoing monitoring of it, and for the risks that it might pose. And for the firms that we discuss this with, we know that a particular problem here is in relation to expertise. So you might have one person within the firm who is all over what AI means for the firm, how it's used, but if they're on holiday, if they're off sick, if they move firms, that presents a key risk to firms in terms of their governance structures. And so what firms really need to be doing is thinking about the way in which the FCA and the PRA, if relevant, have mapped their existing frameworks to how AI should be thought about from a governance perspective and seeing whether they meet those expectations. Because the risk is that if they don't, then we will see some specific AI regulation from the regulators because they will take the view that that is needed to bring firms into line. And what I don't think we will be seeing in the near future is anything that looks like the AI Act. But obviously, we can never be entirely sure on that.
And Becky, do you think firms are developing, deploying AI evenly between business generative areas and risk control areas? Or are they doing what they want to on the business side and waiting for the regulators to tell them what to do on the controls side?
I think there's a bit of both. And so there's been some interesting developments, I think, in relation to the deployment of AI in, for example, a back office type function, where there are definitely efficiencies to be earned in the way that AI can help firms deal with those sort of day-to-day tasks. We're also seeing this in really innovative ways in which AI can be used to improve things like customer experiences. We're seeing it evolve in relation to the deployment of advice. Obviously, we know that there's an agenda to try and close the advice gap and where AI might be useful in relation to that too. So we're seeing firms look at it from very different ways in relation to the ways in which they manage their businesses. But clearly, the risks exist in every way in which it's managed. And I think particularly if AI doesn't function as firms think it would, if it goes rogue, then there are clear risks, one, to firm stability, but also to market stability, and also then in relation to the ways in which customer outcomes are received as well.
And so can firms expect any more targeted regulation or guidance this year? And what do we think the regulators are going to do in 2025?
So at the moment, it looks unlikely that we're going to receive some financial services targeted regulation. I think first we'd see some primary legislation that perhaps wasn't targeted at financial services specifically, but more AI generally and the way in that's used in the UK. But again, that's currently not on the government's agenda, although there was a reference to it in the King's speech in the middle of 2024. But what we are seeing is the regulators carry out a lot of diagnostic work in relation to the way in which it's used by firms. They want to understand how it's used, what the benefits are, what the risks of it are, so that they can make sure that they tailor their frameworks and their guidance to manage those risks appropriately. Interestingly, we're also seeing, though, the regulators develop their own use of AI And particularly, they've talked about it to spot enforcement trends. And we can see it being very useful in a transaction and a monitoring perspective and from a MAR perspective. So it's useful both for firms and for the regulators. And I think what will be interesting is to see how that develops over the next year and what we perhaps see come out from the regulators in relation to their own use and governance of AI that then firms can use as a base for their own. We're also seeing some innovation from the regulators. So we have the FCA's AI Hub, again, to help it promote the use of AI in a positive and generative way, and to help the FCA help firms develop their use of AI in a way in which the regulator likes, and not just in a way in which is beneficial to firms as well. We also have that really interesting dilemma where firms who might be subject to AI regulation more globally have a difficult decision to make in relation to their implementation of AI governance. And so do they take the highest common denominator? For example, if they're also subject to the EU AI Act, do they implement globally for that? Or do they still take a jurisdiction by jurisdiction approach to governance and implementation? And we're seeing a mix of that at the moment. And I think over the next year, we might see a more market-driven approach to AI governance more generally across big financial institutions.
That's really interesting, Becky. I mean, it's a classic dilemma, isn't it, for firms where they can see someone leading the agenda and they don't know whether to do it the same around the world. Maybe it depends on whether you're a UK firm or an EU firm or a US firm as to whether you're following the EU AI Act or doing something else. It'd be really interesting to see how people approach that. Just moving on to another sectoral trend, Nicola, what are we expecting this year in relation to ESG?
Yeah, thanks, Rob. So 2025 really represents something of a watershed moment in the context of the ESG agenda in the UK. We're going to see financial institutions being affected by mandatory ESG disclosure regimes and a new government that has reinvigorated the rather ambitious sustainable finance strategy. So UK firms will really feel the impact of the ESG focus across their enterprise level and product level disclosures, in addition to their internal risk management frameworks. So one thing that's really notable on the enterprise level is this shift from climate financial reporting. Just bear in mind that climate is just one sort of data point of the overall sustainability pool of data across the environmental, social, and governance potential. So this is notable in the context of the TCFD regime, which first came into force for premium listed companies in December 2020 and has since then been brought into force for a number of different types of firms to start reporting on. The UK government is going to implement mandatory TCFD disclosures across the whole of the UK economy. And that means that firms that may not have been reporting on, for example, the climate exposure of their sales and trading or broker dealer platforms before, having to think about how to do that. It's also very interesting because it means for firms having to report on climate exposure under TCFD, more and more of the corporate clients of those firms will be producing TCFD reports. And so, to the extent you are lending to companies, you have more data available to you in terms of your climate risk exposure in your loan book. So, quite a lot happening just in the climate space. But I think the really notable thing is the shift from pure climate financial disclosure to the full spectrum of sustainability disclosures. So, what do we mean by that? That's effectively a fulsome range of disclosure categories across environmental, social, and governance data points. So the UK has already published its guidance for transition plans, and that is going to be supplemented in the first half of 2025 by the FCA and the Treasury consultation on sustainable disclosure requirements under the UK Sustainable Reporting Standards. So those sustainable reporting standards are expected to be based on the international ISSB standards. And that is relevant because it's going to give the opportunity for UK companies to comply with a globally harmonized set of sustainability disclosure standards. So to echo your point, Rob, one of the things that has been very prevalent in the context of the ESG agenda is, should firms just comply with the highest common denominator of regulatory regimes when they're thinking about their enterprise level ESG reporting? To put that another way, does it make sense for your European group to have a separate enterprise level ESG report compliant with CSRD as compared with your UK domiciled group, or even your third country domiciled entities or groups? And so, from a UK perspective, we've been very focused on global harmonization and building a regime which is consistent with the most commonly recognized sustainability disclosure standard in ISSB. So that effectively starts to bring the UK into line with a bunch of other major economies: Asia Pacific, South and Central America, and Africa. And then we just have the United States remaining as an outlier in terms of not yet endorsing ISSB at the federal level. So aside from ESG disclosures at the enterprise level, we'll also start to see progress on the topic of the UK green taxonomy. That is following a consultation launched at the end of 2024 on its value case. So interestingly there, the utility of a green taxonomy is broadly widely recognised across lots of different jurisdictions. It's seen as a key way to tackle some of the challenges, some of the risks that firms face in terms of greenwashing, and helping to have more certainty around the challenging of investment into green economy activities. But pressing ahead with the UK green taxonomy is something that necessarily warrants quite careful thought. There's a sense that we need to do it if we're going to maintain our posture as a very ambitious leader in the ESG space. But it's also challenging because we need our taxonomy to be interoperable with other countries' own taxonomies, which are still developing. And we therefore need to develop it at a pace which is mindful of what other global jurisdictions are doing and how they're looking to shape their taxonomies. So like with sustainability disclosures under ISSB, it looks like the UK is at least mindful of trying to keep pace with what is happening on a globally consistent basis in the context of what's known as the common ground taxonomy. So we'll wait and see what we do on the UK taxonomy, but it seems like we're going to be a little bit cautious, at least in terms of our pace of implementation. One other point I wanted to flag in the context of the ESG agenda has been a more controversial proposal for the FCA to try and bring in, and that relates to the proposals on diversity and inclusion, and in particular the expectations that financial institutions disclose metrics on diversity and inclusion. We're expecting an update from the PRA and the FCA on diversity and inclusion after quite a rocky road to reform. So about a year ago, the FCA and the PRA published consultation papers outlining their proposals to boost diversity and inclusion across the financial services sector. That consultation then stalled as a result of the House of Commons Treasury Committee's Sexism in the City inquiry, which raised concerns regarding the proposed rules, and specifically the concept of collecting and reporting on data and the need to set targets. We will wait to see how the new government's own legislative plans for a Race Equality Act and ethnicity equal pay rights shape the regulators' plans in that context.
Wow, that's a lot happening, Nicola, on the enterprise side. What about on the product side?
Well, the product side agenda is operating in parallel and with just as much gusto at the moment, Rob. So the Sustainability Disclosure Regime, SDR as it's known, that's the regime that outlines 4 different sustainability product labels that can be applied to investment vehicles manufactured by UK managers for retail funds. And it was launched alongside product and entity level disclosures, and also the UK's anti-greenwashing rule that is applicable to all regulated firms. So last year we saw SDR come into force on a phased basis, and 2025 will continue to see that phased implementation of the regime, as well as extension to portfolio managers and overseas funds. So a lot to look out for in the context of fund disclosures. The government has also been very focused on the introduction of a regime for ESG ratings, and has laid out its proposed amendments to the RAO to include a new regulated activity of providing an ESG rating in the UK. What will happen next on that is that the FCA will publish a consultation and create a new regulatory framework effectively for the production and dissemination of ESG ratings. That regime's on a little bit of a slower burn, not least because we need the FCA process to run its course. And so it's likely that the new regulatory regime for ESG ratings won't come into being until around 2029. And that can be contrasted with a very, very similar regime that's happening on the EU side for ESG ratings that we'll see come into force a couple of years ahead of that.
And so, Nicola, what are the main ESG-related risks that firms need to be thinking about this year?
Yeah, thanks, Rob. So ESG risks is a question we get asked a lot about. And I think just at a very holistic level, when you're thinking about ESG risk as a regulated firm, it's best not to think of it as necessarily a new category of risk, but it's almost like applying an ESG lens to your existing enterprise risk management framework. So ESG presents a whole plethora of different risks. It presents financial risks, it presents disclosure risk, misstatement risk, better known as greenwashing risk. It also presents supply chain risk and contract risk, where your contracting counterparties don't meet their own sustainability objectives. So we always talk about ESG risk as something that needs to be weaved into your existing risk management framework. But if there was one very pertinent risk that I think is front of mind as we move in towards 2025, we like to say that more mandatory disclosure standards across a very significant amount of different E, S, and G metrics, not all of which are that easy to collect the underlying data on, so not all of which are particularly easy to have kind of demonstrable, substantiated background to, creates new greenwashing risk. And financial institutions are effectively large global enterprises, and certain climate lobbying groups and other ESG lobbying groups like to make examples of financial institutions. So what we're going to see over the course of 2025 and 2026 is financial institutions putting out quite extensive, wide-ranging ESG reports, and climate lobbyist groups and other stakeholders looking to pick holes in the disclosure in those ESG reports and trying to bring litigation against regulated firms to hold them accountable for the role they play in the sustainability agenda. So we expect to see, a continued focus on ESG related litigation, and concurrent with that, continued focus by global regulators on enforcement actions in the context of the ESG agenda, and again, pertinently around greenwashing risk. So from a UK perspective, we have the new greenwashing rule in play. Many firms think that's just effectively a lot of guidance around the existing obligation to have fair, clear, and not misleading communications. But it is at least a marker that the FCA is focused on greenwashing as a particular way in which firms may struggle to meet that obligation. And so applying that guidance is quite key to your ESG disclosures.
Thanks, Nicola. I think it's really interesting to think of ESG risk as another way of looking at some pre-existing risks rather than a new one on its own, as perhaps it was when it first emerged. And I think it's clear that ESG will continue to be an important cross-sectoral trend in 2025. Just to move on to a third one, Becky, on operational resilience has been a key focus for several years, but seems now to be an even larger priority. Why is that, and what do you think we'll see in the year ahead?
So in terms of the year ahead, Rob, for those firms to which the FCA's new operational resilience framework applies, they have to comply by the 31st of March. But that doesn't mean that they are then done. They then have to carry on complying and operating within the impact tolerances they have set for their important business services in accordance with that new regime. And it seems that that new regime has been introduced largely in response to the increasing reliance of firms on technology and sophisticated systems, and also perhaps in the increasing rise of AI in those things as well. and also the cross-reliance of firms within the financial services sectors on the same providers of those things. And so where we have seen across the last couple of years, the FCA saying that the data it receives from firms on the disruption to their businesses from operational resilience issues rise year on year, and the FCA taking the view that its existing framework perhaps wasn't the impetus for firms to do more to stop those things from happening. There have been a couple of high-profile issues over the last year where the FCA has come out and said that firms that had taken account of its previous guidance had minimal impact on their businesses when compared to those firms that hadn't acted in accordance with that guidance. So some of this is the FCA bringing that guidance bar up into rules rather than just guidance that firms can choose to comply with or not, and bringing all firms up to the same level so that when those things happen, as they're increasingly likely to do, given the reliance on technology, that all firms should be at the same level in terms of their resistance to those things happening. And so that involves, based on FCA guidance, firms doing some extensive wargaming of the things that might go wrong to their firms. So what are their tolerances and reliance? What happens when things go wrong in those areas? Do they have a clear plan in place for when those things go wrong? Do they have things like the documents ready? Do they have emails ready to go? Do they have comms ready to go? So they have to do as little as possible to react to those incidents when they happen, and can react really quickly and nimbly. So it's really firms focusing on, we hope those things don't go wrong, but assuming they do, what can we do and how can we do it really quickly there? And then that helping, because it will not only help the firms, but it presumably then helps the market at large respond to those incidents in a better way. And then also then that consumers aren't impacted adversely by the output of those things when they do happen, and also an increase in market stability also when those things happen. And it's of course then sort of intricately tied into the new critical third party regime. And so we might see over the next year the Treasury name some critical third parties, and there's perhaps some political impetus behind who might be on that list. That remains to be seen, but it'll be an interesting list when it comes out. But that will then clearly feed into the way in which firms, both within the FCA and the PRA remit, react to those firms going onto that list and how that interplays with their own operational resilience. So I think a lot to see over the next year in relation to operational resilience. There'll no doubt be an FCA review of how firms have embedded that, and there'll no doubt be an incident this year when firms' new plans will be tested. And so then we'll see whether or not those new rules are effective.
Becky, you mentioned the remit letters there, and I think that the PRA and the FCA are clearly under some political pressure at the moment. And so interesting to see that link. Nicola, what should we expect structurally from the regulators? They've had a lot of scrutiny. They're getting these remit letters. Nicola and then Becky, do you think we'll see any changes in their approach going forward to try and move with that mood music?
Yeah, it's a very interesting time, isn't it? I mean, to some extent, inevitable. You have a change of government. You have a change of government that is incredibly focused on the growth and competitiveness of the UK, because it's taking control at a time when the UK has, in recent memory, left the European Union and is sort of rebuilding its model in terms of how it stands on its own 2 feet in an international context. And so that inevitably leads to, a potential shift in focus and expectation of the regulators, which to some extent seems like it's pointing blame that what happened before was the wrong thing to do, but everything should be viewed in the context of the time and the environment it was in, of course. But those remit letters you referred to, Rob, are very interesting, particularly in terms of the tone. I think that both the PRA and the FCA had a largely defensive stance in responding to the progress reports from the government in terms of reaching those growth and competitiveness targets. FCA was quite humble and said they recognise that the jury is out on whether it's helping to achieve growth, and that it clearly has more to do, which points, I think, to more structural changes. And likewise, the PRA speech had a pretty defensive tone, so kind of reaffirming its commitment to its new objective, but saying it was necessary to approach that in a careful and balanced way. So I always think about growth and competitiveness, in an international context, and what really drives business to the UK when we're talking to international businesses that are thinking about setting up operations here. It's often driven by pay and individual personal accountability. And those are two areas where we're starting to see our regulators really focus on aspects of the remuneration regime that can be amended to be more competitive, and likewise aspects of the SMCR regime that can be amended to be more competitive. And so I think in terms of how the regulators will react, there will definitely be focus on this international piece and how we can restructure our regime to continue to allow the UK to be very amenable to that international flow of trade.
It's interesting to hear how quickly the government's approach to international competitiveness is forming part of the agenda for how the regulators will function, Nicola. What do you think, Becky?
Yeah, I'd agree with everything that Nicola has said, and I think it's really interesting because the UK regulators are, particularly hands-on regulators. They like to get their arms around the issues. They like to be reactive. And I wonder whether some of the move towards a more principles-based approach to regulation is to also allow the FCA in particular there to loosen the reins a little bit on some of its consumer protection agenda and allow it to help foster those things in relation to competitiveness and growth, where sometimes the interventionist nature of the FCA can be a little off-putting to those institutions that want to set up new business here, particularly when we look at the FCA's track record for issuing fines for regulatory non-compliance. And so hopefully going forward, if there is this principles-based move in a broader way than under, for example, consumer duty, that might allow the FCA to be more targeted in its approach without losing face, for example, in saying it's not being as protectionist as it has been, but that's often a quite difficult sell and a bit of a climb down for a regulator. So I do think it'll be interesting how it approaches its call for evidence for a more principles-based approach to regulation generally, and how that will then feed into the much broader agenda for the UK's competitive agenda in financial services going forward.
So a lot coming up in a cross-sectoral sense, even if there's no specific rule book you're following, plenty in 2025 from the regulators and the global agenda on topics like AI and ESG to come. Nicola, Becky, thank you for joining me today.
Thanks for having me, Rob.
Pleasure, Rob. Thank you.
I hope you enjoyed that discussion of important sectoral trends in financial services, and it'll be interesting to see how they develop as the year unfolds. Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Spotify, or wherever you get your podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you've enjoyed all 3 episodes on wholesale markets, retail markets, and sectoral trends, and that you enjoy other Latham podcasts in the future.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.